Let's find out if dividends are a viable way to make money in the stock market. In 2024, I've invested $1,000 into 10 different high-yielding dividend stocks and ETFs to see if they'll end the year profitable or if they'll lose me money. The key to this experiment is to track the price appreciation of each stock as well as the dividend income generated. At the end of 2024, I'll put this account up against the S&P 500 and see which one is the winner. The S&P 500 has a remarkable history of averaging 7 to 10% every year for a very long time, so I think this is a good way to see if dividends can actually make you more or if they fall short of that goal. The goal for this specific account is not only to find out if dividends are a good way to invest, but also which of the 10 dividend stocks and ETFs chosen will turn out the most profitable. Part 1 showed the first 5 dividend stocks and ETFs in the account, and now we're in Part 2 to see the next 5. We'll compare the two sets at the end of the year as well. Do you know all of the 5 stocks and ETFs in this video? Leave me a comment on which one will make the most money that you think for 2024, as well as which one is your favorite. One of the stocks is already down 30%, and we'll get to that. It is rough. And to make matters worse, it was the worst performing stock of the 2023 Dividend Account Challenge. So watch till the end to see the horrible decision I made with this stock. Stock number 6, the first of the second 5, is ticker MAIN. This is an extremely popular fund that we've seen. It's a popular BDC that is well known for its growth as well as the strong dividend, two really good factors that you're looking for with dividend stocks. Now, the dividend yield is currently 6.6%, which is one of the lower yielding stocks in the account, but definitely not the lowest. The price appreciation makes up for that, though, as in the last year it went up over 18%. And it has a really strong market cap of $3.66 billion, a little bit smaller for a BDC, but not terrible by any means. As for their dividend history, it's been paying out since 2008 with 2 years of consecutive dividend growth. Their special dividends are what make this stock amazing. Prior to 2021 market crash, Maine was paying a ton of special dividends, and now they have paid 2 special dividends in the last year, which is great, and I'm hoping they continue that trend, but you can't count on special dividends because they are a random thing. It all depends on how the company does, just so you know. Another pro for Maine is the fact that it pays monthly. I love getting monthly dividends in my account. Now, one of the main downsides is its CAGR, the compound annual growth rate, which is only 3.71% over the last 5 years. So this is the rate at which they grow their dividend. So a lot of larger dividend companies like Johnson & Johnson and others have a very low compound annual growth rate because they've been around for so long and paying consecutive dividends for so long. So I do like these smaller companies to have a higher CAGR. But they have kicked it up because the last 3 years it's 6.05%. Now, I do want that growth to be a little stronger, like I said, but I'm going to be watching this one extremely closely, and I've even considered putting some of my private Roth account into this stock because I love it so much from my research. So at the end of this challenge, we will see if it's a good idea or not, and it may impact if I actually end up buying this one again. Now we're going to move on to a very well-known dividend king. All right, ticker MMM. This is 3M Co., and it has had it rough. Really, really rough, actually, the last few years. So for those of you that don't know, the stock is down 43% from 5 years ago. And there are a number of reasons for that, and they are pretty significant reasons. The main being that a few bad lawsuits, which were ongoing, put a lot of fear into the stockholders. So this is a really popular, very more old-fashioned kind of stock. But now that the lawsuits have settled down, and a few of them are actually settled completely, I think the stock could have a nice comeback. So we're going to start out with the phenomenal dividend yield of 5.5%. Now, I do say phenomenal because the dividend yield plus the dividend history make this one an almost immediate buy for me, besides these lawsuit issues. Because having both of those, having a strong yield and strong dividend yield history is really phenomenal. And the market cap is $60 billion. So even though they're paying out a lot of money in lawsuits, a $60 billion market cap, it's going to be hard to find a competitor to this stock. The dividend history for 3M is the best in the account. It has paid out dividends every year for 65 years. So a lot of people love these long time paying dividend stocks because they just have more faith in them. 65 years without cutting the dividend. And it actually has increased its dividend every single year as well. Now, it may be a little bit lower in increases than, say, a newer high yielding dividend stock or ETF, but still 65 years of growth is phenomenal. It does pay quarterly, which isn't the best, but it does make it one of the safest stocks in the account, except for the recent lawsuit. So we'll see if that safety term really actually ends up being true with 3M. A yield that high with a strong dividend history makes me very hopeful for the future of this company. Plus, the boomers will never let go of this one. I promise you, it is one of the most popular by older people investing, I believe. That is just speculation. I didn't look that up. I just know from personal, which could be an outlier, could be biased, but that's just what I know from people that I know who invest who are older. So one of the problems with this many consecutive dividend increases is, like I said, the compound annual growth rate is pretty low, around 2%, which is not bad at all for a company with this dividend history. But the sector medium for 3M is 6.7%. So it's a third, it's even less than a third of the sector median. Just something to note, but you're buying it for the safety as well. And I want to see how it compares to the other stocks. Now that we've seen this dividend king with lower risk and lower rewards, we're going to talk about a really high risk, high reward REIT that I've had my eye on for a while. Let's jump into it. Ticker VICI. This is Vici Properties. It's a REIT with very, very little dividend history. So always be careful, guys. You want to look at dividend history to see if they've had cuts and whatnot. Now, Vici hasn't, of course, but it only has been around since 2017, where it was formed as a spinoff from Caesars Entertainment Corporation, which was part of a bankruptcy reorganization. So always be careful with little dividend history. But when it comes to Vici, it's not the best reason for this company to start being a bankruptcy reorganization, but we're going to look at the details before we judge it too harshly. It has a 5.24% dividend yield, which again is lower in the account than some of the others. But the reason I added this REIT is because of the growth potential. It is phenomenal. If you had purchased Realty Income the first few years after it had started trading, you would be really wealthy right now. And I think Vici could have similar potential as it's in the entertainment space with properties on the Vegas Strip. So my opinion on this is the Vegas Strip is one of the most popular places in the U.S. to go. It is known by almost everybody, and everyone goes there at some point in their life. So I don't think it's going to stop being extremely popular because of what goes on there and because of just the beauty of it all. It's extremely popular. They're building new things. It's a phenomenal place to go for vacations. So with that $33 billion market cap, this is not a small company, but it does have 54 dynamic gaming destinations and 39 non-gaming experiential properties. Plus, when you add in 4 championship golf courses, boom, this is a small but lucrative company and a not small market cap wise. So it is a huge market cap because these properties are so unbelievably expensive. So $33 billion split between under 100 different properties is pretty wild. But you do take on a lot of risk owning this company because it's still in its infancy. It has had 5 years of consecutive dividends plus growth every year, so it is performing well. And it has an outstanding compound annual growth rate of 10.05% for the last 5 years. 10%. Everything we've seen so far has ranged from 2 to 6%. So 10 is phenomenal. And you normally see larger compound annual growth rates from companies that are newer because they can afford to continue to increase that dividend when they are profitable. So it's extremely hard to beat that. But it actually is the highest on the list for compound annual growth rate. Now, there is no telling what this stock will do, but I'm going to be here for the ride. And if you're subscribed, so are you. So now we're going to move on to a safer and a more insane dividend history company. Let's talk about ticker LEG. Leggett & Platt is a wild dividend stock with an insane dividend history, similar to 3M. It has a smaller market cap of $3.41 billion, significantly smaller than 3M's $60 billion, but a dividend history of 51 years of consecutive dividends and dividend growth each year. So it's a few years behind 3M, but Leg has also had a rough go of it lately, with it being down 24% in the last year and 33% in the last 5 years. So not nearly as bad as M as well. The stock definitely does have some rebuilding to do, which I do see as a bright side as the market has been all over the place. And I don't love watching these stocks tank, but when it comes to dividend kings, it can be a great bargain to buy some of these shares at a discount. Now, it's not financial advice. It's just usually what I do, and I'm not a financial advisor. It all depends on your risk tolerance. And if you see that a company is going to do well in the future, if you predict it's going to do well, then that's a good opportunity for you. So it's an excellent time to remind you, again, not financial advice. Always do your own research and take your time to understand stocks or ETFs before you're purchasing it and do your own due diligence. I do have a full 5-minute DD section where I do due diligence on stocks. If you are interested, go check that out. And subscribe if you like the video, anything. Moving on. Now back to why I love LEG. The dividend yield is 7.2%, a huge dividend yield from a dividend king. So it's a double whammy. You got a dividend king status with a high yield. So most of these kings, they yield between 1% and 3%. Again, Johnson & Johnson, Coca-Cola, but not Leg. It is performing extremely well. Plus a compound annual growth rate of 4%, which is a little bit low, but not awful. Definitely better than like we saw with 3M's 2%. It definitely has some work to do to become an all-star stock. But if you believe in this company and you believe in the dividend history, it could be a moneymaker, especially at these discounted prices. Now moving on to the problem child stock that we talked about earlier, I added the next stock to the account and it already has tanked 30%. What was I thinking? If you think I was stupid, let me know in the comments. I had faith in this company and I liked it, but still it's already proving me wrong. The worst performer of the 2023 1K dividend challenge, ticker MPW. Yeah, I don't know why I did it to myself once again, put my own money into MPW when last year it ended down 56%, but I thought maybe it would bounce back and could be a good opportunity, and I did. This wasn't just a pipe dream. I did look into the financials, and I knew that they were waiting, but it was a little bit of a gamble. So we'll talk about exactly why it cut and everything like that, but it had recently cut its dividend by half after all the chaos of last year. So I thought it would be a good option, but boy was I wrong. Despite already losing me 50% in last year's challenge, MPW dropped 30% already since adding it to the account. It is the biggest loser so far, already down 30%, but I guess we'll treat it fairly and talk about why I added it. So normally I run from stocks with recent dividend cuts, but sometimes a cut can make a stock more appealing depending on why they're cutting it. So MPW cut its dividend to have more capital for other things and to be just a safer investment overall. And now the yield was insane. It had a 24% dividend yield. So a cut to 12% is not a bad thing in my opinion. It's a lot more realistic and it lowers the dividend payout ratio, which makes it a safer buy. Since the recent drop, the yield is now back up to 17%, which could potentially push for another cut in the future, but I'm waiting to see what happens. Has a smaller market cap of $2.1 billion and owns primarily healthcare facilities. But with the 2 dividend cuts since 2008, I'm rethinking my faith in this stock. And if it is the worst performer in 2024, I'm definitely not buying this with ever again. I will watch it, but I will never purchase it again because it is killing me. Initially, I thought that if they got their tenants to pay up and pay their full amount, that the share price would rebound really nicely after dropping almost 80% the last 5 years. But the bounce back did not happen. It was a long shot, and now only time will tell if this company can get its largest tenants that make up around 20% of their client base, 20% of their income from this one tenant to pay their full rent. Right now they're paying half, which is insane. Not even half. This has been ongoing as we've seen over the last couple of years, but if they can pull this off, I really do think that the shares could go crazy. If news comes out that either the company filed bankruptcy or they're getting rid of it or anything like that, that would help MPW's vision, it could be great. But until then, I'm just going to be watching it sink in my account, and we'll see if the other stocks can make up for the loss MPW has once again caused. Because of the dividend cut, they now have a negative compound annual growth rate, which is terrible. Really, this stock, it goes in the account to show everyone what you own. Be careful with what you own and always diversify. I'm still slightly hopeful for this. It's definitely still the riskiest stock in the account, but if the downtrend continues, the stock's going to continue to cost me money over and over and over again. So these are the final 5 stocks and ETFs in the 2024 $1,000 dividend account challenge. I'm going to repeat myself that this is not financial advice, and you should always do extensive research before purchasing a stock or an ETF. If you do want to follow me on this journey and see how much money I actually make in 2024 with just $1,000 with these high-yielding dividend stocks, hit that subscribe button and let me know. If you own any of these stocks, drop a comment as to which one and why you own it and how they performed for you. Maybe some of these have already performed well for you, and that's a good vision for me in the future. Maybe they'll perform well, but we will see. And then as always, thank you guys for spending some time with me. And if you want to watch part 1, I will link it below in the description. I'll see you in the next one.